I'm sorry, just a minute.
Yeah.
The first, as well as the last budget of the current government was tabled in the Parliament on February 1st, 2023. Good afternoon. I, Shreya Malhotra, on behalf of the BRICS Chamber of Commerce and Industry, welcome you to this webinar on Insights of Union Budget 2023, where we look forward to exploring the new policies and amendments introduced. We'll also try to understand the key highlights of Budget 2023 and its significance for the public, businesses, and Indian economy as a whole. Our panel today consists of eminent personalities from the industry. Today we have with us Ms. Nidhi Goel, Managing Partner at Avinav Consulting. Ms. Goel is an MBA and CA with over 25 years of experience in financial, tax, and regulatory matters, and has work experience with professional firms of repute. She has been active in working in sectors such as aviation, aerospace, defense, infrastructure, including roads, power, tunnels, ropeways, etc. Her experience includes rendering financial advisory, financial modeling, structuring advisory, mergers and acquisitions, joint ventures, and technical collaborations. Mr. Pranshu Goel, partner at Ashok Pranshu and Company. Mr. Pranshu is a member of Institute of Chartered Accountants of India and a law graduate. He has considerable experience in advising large corporate houses and high net worth individuals on a variety of tax matters. He has also represented clients in tax litigation and prosecution matters before various appellate forums. He also has experience in advising clients on federal tax laws and reporting compliance in the United States. He regularly contributes articles to a variety of journals and professional practice manuals. Pranshu has co-authored the Tax Disputes and Litigation Review, 3rd edition, published by Law Business Research Limited. Mr. Shankey Agrawal, partner at BMR Legal Advocates. Mr. Shankey specializes in tax litigation and has been involved in a number of high-stake litigations with over 13 years of experience in both direct and indirect tax litigation, which is his area of expertise. He obtained his Bachelor of Law degree from an esteemed Indian Law Society, Law College, Pune, and is also a qualified company secretary from the Institute of Company Secretaries of India. He has qualified as an advocate on record of the Supreme Court, along with being a member of the Bar Council of Delhi, the Supreme Court Bar Association, the Supreme Court Advocates on Records Association, and a fellow member of the International Fiscal Association. Mr. Sarthak Garg, partner at Garg, Manoj and Associates. Sarthak is a chartered accountant by profession and a member of the Institute of Chartered Accountants of India. Sarthak has vast experience in field of indirect taxation and is currently leading the indirect tax practice at Garg, Manoj and Associates, based out of New Delhi. He has worked across various industries, including healthcare, hospitality, automotive, FMCS, and dairy industry. Mr. Sourabh Besar, partner at BGJC and Associates. Sourabh Besar is a qualified chartered accountant with over 8 years of experience in indirect taxes, advisory, and litigation. He is currently a partner at BGJC and Associates, LLP. Sourabh also has worked with Deloitte in the past and has been actively engaged in advising the clients across multiple sectors under GST as well as under erstwhile tax regime. I would now like to call upon Ms. Nidhi Goel, the moderator for this afternoon, to kindly initiate the session. Over to you, ma'am. Nidhi, ma'am.
Yeah, thank you, Shreya. And thank you, Shreya and Ankita, for organizing this budget session. And I think this is our 3rd session of 2023. And earlier we already had 2 sessions. So that's my understanding. And thank you to everybody at BRICS for organizing this. And I would also like to thank you for 2 speakers who are going to speak on both the subject, direct and indirect taxes, and of course all the participants who have joined us today to know, of course, insights of the budgets and lots of things. There are certain hidden things, there are certain clear things which are coming out of the budget. So, of course, besides, before we start direct and indirect taxes changes, so I would just like to mention a little bit about the India update on the from the economic side. While GDP of India is estimated at 7% in financial year 2023, IMF projected 2.9% global economic growth for 2023. And India is showing the highest GDP among its developed, emerging market and developing economies, that is 6.1 and 6.8 in 2023-24. Agriculture is expected to grow by 3.5% in this year, manufacturing at 1.6%, and construction and services sector at 9.1%. And of course, there is an expectation that hotels, transport, and related services is also going to grow by 13%. The revival of constrained demand for hospitality sector is again increasing. Resumption of travel, real estate, professional services growth is expected to moderate to about 6.4%. Lower fiscal deficit in 2024 is expected to be 5.4%. Government has mentioned 7 priority areas, Saptarishi, in this year, which is infrastructure, unleashing the potentials, green growth, youth power, new courses, AI robotics, tourism, unity malls, financial sectors, and then including development in health, education, and agriculture. And government has also budgeted an increase in net tax revenue with various measures which they have introduced, reducing certain rates of customs duty, but at the same time increasing certain customs duty rate in case of the non-required or less required items imported into India. And then 15% increase in non-tax revenue for 2023-24 as compared to the last year. Emphasis has been in the new tax regime, personal taxation, increase of limit of revenue of small enterprises and professional services, giving benefits to them. So among others, there are many other changes, which now I would like to hand over to Pranshu for taking the detailed changes in the direct taxes. Over to you, Pranshu.
Thank you so much, Nidhi. Thank you, Ankita, and thank you everyone from BRICS for organizing this. If you can just share my screen. Yeah, thank you, Nidhi. So, good afternoon, everyone, and welcome to this seminar and session on the Union Budget 2023. We start with the direct tax key proposals. So when this budget came, every year I look forward to the speech of the finance minister. And this year I was taken aback because this was one of the shortest speeches of the finance minister ever. In her last total five speeches which she gave, this is amongst the shortest. And I was wondering whether there would be any changes made to the direct tax and whether it would be anything for us to chew upon or to speak. But when we opened the finance bill, there were your whopping 122 amendments in the Income Tax Act. So, as always, the government makes numerous changes to the Direct Tax Act, and there is always a lack of stability and lack of reliability in terms of taxpayers, because every time or every year, plethora of amendments are introduced. But when we go through the finance bill this year, although there are 122 amendments which are proposed, but there are no much fireworks as such. The proposals or the amendments which are being introduced or proposed are not that major changes which are proposed either in the procedural side or either on the chargeability side. Though there are few interesting amendments which are assumed or understood to plug the small loopholes, but there are not much major fireworks, as I say. So let us go through each or few of the important amendments which are proposed. One of the amendments which is most deliberated and discussed about is the new tax slab rate, because this impacts a lot of of a lot of our population, and it is presumed and understood that this new tax regime or slab rate would enhance the tax base of the government, which is one of the foremost criteria of the government. So since this government has come into power, their first aim is to reduce litigation and increase the tax base. So they are working on it, and there are few amendments which are proposed in that direction, and one is this new slab rate. So as per this new slab rate, now if you are having an income up to 7 lakh rupees, you don't have to pay any tax. So supposedly you have an income of 6,99,000 or say 7 lakh rupees also, you don't have to pay any tax at all. But the moment your income crosses 7 lakh rupees, the moment it becomes 7 lakh 1 or 7 lakh 10, then you have to pay tax, and the tax would be calculated as per the slab rate in the table which is shown here. So up to 3 lakhs, there is no tax. From 3 lakhs to 6 lakhs, there's a slab of 5%. So if you are earning 6 lakh rupees as income, your tax would be 5% of 3 lakh, that is 15,000. Then from 6 to 9 lakhs, it is 10%. From 9 to 12 lakhs, it is 15%. And from 12 to 15 lakhs, it is 20%. And above 15 lakhs, it is 30%. So now we need to understand that this is the revised slab under the new regime. Last year, prior to that, the government introduced a new regime for individuals and HUF, under which no rebate, no deduction, no benefits were provided. So this is the new slab under that special regime. And as per the intent of the government or the speech of the finance minister, this would be the default scheme which would be carried forward in future. And they would transition into this in near future as well. So if you want to carry on with your old slabs, which is 2.5 lakh to 5 lakhs and so on, then you have to opt out of the scheme, because this scheme would be now the default scheme. Under this scheme, they are also giving you a benefit in reduced rate of surcharge. So the highest rate of surcharge was 37%, which under this new slab, new regime, would be considered to be at 25%. So someone who is at the highest tax bracket and who's a high net worth individual having an income of say above 5 crores had to pay 42.74% of income tax. But now its effective tax rate would be 39% rather than 42.74%. So there is a reduction from 37% surcharge to 25% surcharge in the highest tax bracket. This new slab is applicable from assessment year 24-25. So this is not applicable for the year which is just going to end, that is financial year 22-23 or assessment year 23-24. This would be applicable from assessment year 24-25. Another amendment which is introduced is on the presumptive side of the taxation. So if we are aware that the Income Tax Act provides for small MSMEs, micro, small and medium enterprises to report their taxes or report their income on presumptive basis. They are not required to maintain any books of accounts. They are not required to get their books of accounts audited. And they can pay their tax on presumption basis, 8% or 6%, depending upon their receipts criteria. So the earlier limits were for businesses, it was 2 crores of gross receipts. So anyone who had a gross receipt of 2 crore rupees was eligible, up to 2 crore rupees was eligible to claim this scheme. Now this limit has been increased for businesses from 2 crores to 3 crores. For professionals like chartered accountants, lawyers, architects, etc., who are covered under section 44AA, the limit earlier was 50 lakhs. Now it has been enhanced to 75 lakh rupees. So anyone in business who has a gross receipt of 3 crore rupees and anyone from profession who has gross receipts of 75 lakh rupees and 95% of their gross receipt is through banking channel, then they can avail the benefit of presumptive scheme of taxation. This amendment or this enhanced slab would be applicable from next year, assessment year 24-25. Another amendment which is proposed for MSME sectors is giving them the benefit of getting timely payments. So I have been associated with MSME board, and I have been discussing this from last 1 year. We have been discussing that the major issue for MSME is recovery of payments. Although MSME Act provides that for every person who is registered under MSME, the payment has to be made within a period of 15 days or 45 days. However, most of the time, either the payments are not coming or either they are bad debts and people have to file 138 negotiable instrument matters or recovery suits before the lower court. So this was a major cause of concern for MSME. Even after MSME Act addressing the payment issue, they were not getting any payments in time because there were no penal consequences as such under the MSME Act, or they were not enforceable as such. So to cater that, interestingly, the government has introduced an amendment under the Income Tax Act. So now the government is proposing that if you do not pay to the MSME within the time frame provided under the MSME Act, then you will not get the deduction of that expense. And you will get the deduction of that expense in the year in which you make payment to the MSME. So this would be a big blow to all the payers, and they would make sure to pay all the MSMEs in time. So for all the MSMEs out here, I would recommend that if you have not taken the registration, you please go ahead and take the registration now and give it to all your sellers to whom you're selling your goods, and state that you are an MSME and this is your certificate and you have to make payments in time. This would also be effective from assessment year 24-25. Another interesting or rebate which is given is to startups. We are into the 75th year of independence and the Amrit Kal is going on, and Prime Minister Modi is advocating the startup culture in India. And we are amongst few countries who have many unicorns around the world and who have given a lot to startup industry. And to give benefit to them, there is a section under the Income Tax Act which is 80 IAC. So Section 80 IAC provides 100% tax rebate to startups for 3-year period out of a 10-year period. So that was for startups who were registered or who were incorporated before April 1, 2023. So the deadline was ending. So that it is by this finance bill, it is proposed that to enhance the deadline for any startup or for any eligible startup who would be incorporated before 1st April 2024 can also claim the benefit of Section 80 IAC. So 1-year period has been enhanced. Simultaneously, earlier, if there is any startup, as we know, most of the startups are bleeding, they are burning cash every day to retain customers, and major asset is their data. So they are reporting huge losses. So to give them the benefit, earlier the period up to which the losses could be carried forward was 7 years. Now this has been extended to 10 years period. So if you have any loss, you can, if you are a startup, if you have any loss, you can carry it forward up to 10 years. Amendments are also introduced for life insurance policy holders or someone who's going to take life insurance policies. So what government noted that many HNIs and ultra HNIs were using this route to generate a tax-free income. So as per Section 10, subsection 10D, any receipt from a life insurance policy, including a bonus, is exempt. You don't have to pay any tax on it. So this was being used by HNIs and they were taking humongous life insurance policies, and the bonuses being received were exempt from tax under 1010D. So to plug that loophole, by this finance bill, it is proposed that for any insurance policy which is issued after April 1, 2023. So this doesn't cater for any insurance policy which is issued prior to April 1, 2023. If you have taken any insurance policy prior to April 1, 2023, that can go on and you can claim the benefit. But for any insurance policy after April 1, 2023, if it has a premium or aggregate premium of rupees 5 lakhs or above in a year, then that person will not get the benefit of section 10(10)(d), and this income would be taxable under section 56 of the act as income from other sources. While calculating the income, the deduction of the premium paid would be allowed if the premium has already not been treated as an expense, otherwise under P&L or under section 57 or anywhere else. This new provision would not be applicable on receipt of funds in case of a death of insured person. So even if a HNI has taken a policy over 5 lakh rupees, but the amount is received on the death of the insured person, then the benefit of section 10, subsection 10(d) would be available. There are very few amendments around non-residents this year, and they have a lot to cheer, because what non-residents want and why they invest in India is they want stability and reliability in the tax laws. So there are very few amendments under this finance bill, but one which is there is with regard to the capital financing. So section 56(7)(b) states or was inserted a few years back to prevent generation and circulation of unaccounted money through share premium route. So many companies were issuing shares at a high premium, even if they did not had any value as such. So supposedly the net worth of the company is say 1 lakh rupees, but they are issuing shares of say value of 1 crore, 2 crores, 3 crores at huge share premium. So it was understood by the department that there is circulation of secondary economy through this, and cash is being routed and generated through share premium and is booked in the books of accounts. So to plug that loophole, section 56(7)(b) was introduced, wherein it was stated that if you are issuing any shares to any resident, then that share has to be issued at a fair market value. And then for fair market value, we had different rules under Rule 11U, UA, UAB, etc. We have different concepts of valuing the shares, market value, DCF, book value, etc. So earlier 56(7)(b) only included resident. Now with finance bill, the word resident is being proposed to being removed, which would mean that now 56(7)(b) would include resident as well as non-resident. So if any company is receiving any share capital either from a resident or a non-resident above the fair market value, then it would be a challenge under section 56(7)(b) of the Act. This would be applicable from assessment year 24-25. Another amendment which is around non-residents is deemed gift provision, though it is not for non-residents as such, but it is to plug the loophole again for not ordinary residents. So if you read the Act, section 6, our Act caters 3 types of residencies: residential status, resident of India, non-resident of India, and then there is a third status which is not ordinary resident. So last year, Finance Act 2019, section 9 was amended, wherein if any non-resident receives a gift from a resident, it was considered to be deemed to accrue or arise in India, and hence it was becoming taxable under section 56(10) of the Act. Now that amendment which was introduced in Finance Act 2019 only spoke about non-resident. So a lot of people who are not ordinary residents, means non-residents, were using this route to take gifts from a resident and claiming it to be non-taxable. Because the amendment which was introduced in Finance Act 2019 was only for non-residents and not for not ordinary residents. So to plug that loophole, This amendment is now introduced under section 918, and not ordinary residents are also made part of it. This would also be applicable from assessment year 24-25. Now there are few amendments around capital gains provisions. So prior to budget, there were a lot of discussion in our circles that the government might overhaul the whole capital gain tax structure, because if you see the capital gain structure right now, it is very complex and very confusing. You have different time period for different type of assets for claiming it to be short term or long term. You have different types of tax rates, 10%, 20% with indexation, without indexation. And then it also varies whether your asset is in India or outside India, whether it is share security, whether it is a bond, debenture, listed, unlisted. So the whole capital gain structure is very confusing, very complex, and it was understood and that the government might change the whole capital gain structure. However, the government did not want to, I guess, touch upon anything prior to the next elections. So they kept it as it is. So be it. So there are few amendments though around it. And again, there is one to cater to HNIs or to ultra HNIs. So there is amendment under section 54 and 54F of the Act. So section 54 and 54F provides for deductions under capital gain. So supposedly you have a residential house and you are selling your residential house and you are buying another residential house. So section 54 said that if you are selling a residential house and any capital gain earned on it would be exempt and would be deductible if you buy another residential house within a specific time period and if you follow the instructions of that section. On the other hand, section 54F said that if you gain or earn, individual or HUF earn long-term capital gain on sale of any asset other than residential house, and you invest the proceeds in a residential house, then any capital gain earned would be deductible through the investment made in the residential house. So this route was used by many HNIs and ultra HNIs to zero on their tax liability. For example, I would say that I have investment in a startup or in a private limited company, and I sell that shares and I make a huge profit of say 100 crores out of it, a huge capital gain, a long-term capital gain. Now, if I do not want to pay tax, I park that 100 crores in a farmhouse or in a huge bungalow or in a residential property. So if I invest that funds within the period in a residential house, I could claim the benefit of section 54F and my 100 crore capital gain would be zero and I would need not pay any tax on it. So to cater that situation, the government has made a cap of 10 crore rupees. So now from assessment year 24-25, if you earn any capital gain and you wish to take benefit of 54 or 54F, you would only get the benefit up to 10 crore rupees. So for example, the example which we just took, if I would have earned 100 crores and if I would have invested 100 crores in a residential property, if this provision becomes applicable, then in future I would only be eligible to claim 10 crore rupees as deduction and my 90 crore rupees would become taxable under the head capital gain, long-term capital gain. So now this was taken as an advantage by HNIs and ultra HNIs, and this has been plugged. We have filed many tax returns, or offices have done many transactions around it. And trust me, by this March 31st, you will see a lot more transactions happening around it and a lot more people investing in farmhouses and huge residential properties and taking their funds out of their company just to avoid this new proposed section. Again, around capital gains, the government has clarified the cost of acquisition with relation to certain type of assets, which are mostly intangibles. So the government says that if you have intangibles which are generated intangibles and you have not paid any consideration for it, the cost of acquisition and cost of improvement would be nil for that. Supposedly, I generated a technology today or I invented a technology and I got it patented and I have not invested anything in it. So the cost of acquisition would be nil. Or supposedly I get my brand registered, I have not made any expense on it. The cost of acquisition of that brand or that trademark would be nil. So this amendment is introduced in section 55 of the Income Tax Act. In capital gains, so people were taking the benefit of double deduction of interest on borrowed capital. So I have a house, I take a home loan and I am paying interest on it. So while paying interest on it, I was taking the benefit under section 80C of that, and I was also taking the benefit of interest under the income from head house property. And now when after 3 or 4 years, when I sell that house property, I accumulate that interest and consider it as my cost of acquisition also. So the government is saying you cannot take dual benefit of the same interest. Once you have already claimed that interest as an expense under the head income from house property or under section 80C, now you cannot consider it as your cost of acquisition while computing capital gains. So this is, they have clarified and made proposed amendments in various sections which would be applicable from assessment year 24-25 again. Now around a joint development agreement, so this amendment is also more of clarificatory nature, though not retrospectively applicable prospectively. So under joint development agreement, section 45, subsection 5A was introduced, which said that in case of joint development agreements, the sale value or the full value of consideration for purpose of computing capital gain would be the fair market value of your share of the property, plus if any cash has been received. So supposedly I had a plot of land, and I entered into a joint development agreement with a builder. And the builder told me, okay, to develop this, I would pay you 50 lakh rupees as cash, and I would give you one floor. So as per section 45(5)(a), my sale consideration would be the fair market value of the floor plus the cash which I have received. Now the word cash was written under section 45(5)(a). So by clever lawyers and chartered accountants, it was stated that since the word cash is written, any amount which was received by way of check or bank transfer would not be considered. So to clarify it and to plug that, the government said that cash would mean or include any payment received through check also and through electronic mode also. So if the builder has paid me 50 lakh rupees through check or through bank transfer, that would also be part of my sale consideration. Section 194 IC, which is corresponding section of TDS for joint development agreement, already stated the fair market value of the property plus check plus draft plus cash. It's just that it was a drafting error which was there in section 45(5)(a), which has now been rectified. Though thankfully it is now taxable or proposed to be taxable prospectively and not retrospectively. Another amendment which is proposed is around taxation of capital gains on market-linked debentures. So market-linked debentures are presently being reported or being taxed as 10% and no indexation benefit is being provided if they are held for more than 12 months and they are considered as long-term capital gain. But the government proposes that market-linked debentures are in the nature of derivatives which give interest-linked performance of the market. So considering the interest rates are going up and down, the market-linked debenture value would also fluctuate. So they are basically of the opinion that any redemption which you get of these debentures or any capital gain which you earn is a short-term capital gain rather than a long-term capital gain. And hence they are now proposing that you will get a benefit of deduction of cost of acquisition, and it should be considered short-term capital gain, and it should be taxed as such as STCG rather than as a long-term capital gain. So the tax rate of short-term capital gain would be applicable and not 10% of long-term capital gain. So TCS on LRS. So TCS on LRS was introduced last year, wherein a 5% TCS was introduced. So what is LRS? So LRS is liberalized remittance scheme. Any resident who wish to travel abroad or who wish to send money abroad have a limit of $2.5 lakh as per FEMA. So as per Foreign Exchange Management Act, any resident who wish to send money abroad for buying shares, equity, or having a bank account or buying a property, or for travel purposes or for medical purposes or for maintenance of their children or want to gift to their children, or there are different criterias or reasons for sending money abroad, a resident can send only $2.5 lakh abroad a year, a financial year. So last year, the government introduced a TCS of 5%. With a threshold that if the amount is paid above 7 lakh rupees, in case of education other or for medical purpose above 7 lakh rupees, 5% of the amount would be considered as TCS. So the bank would charge 5% extra from you, and you would get that benefit of 5% when you would file your tax return in India. For overseas tour package, also it was 5%, or for any other case, also it was 5% without any, for any other case, it was also 5% in excess of INR 7 lakh rupees. So if you propose to send more than 7 lakh rupees within that $2.5 lakh range, you had to share 5% TCS, and that would be given to you at the time of filing your tax return, the credit. Now, interestingly, this 5% has been increased and enhanced to 20%, 4 times. So Finance Bill 2023 proposes to increase TCS on foreign remittance pertaining to overseas tour package and for any other case to 20%. In case of education and medical purpose, it remained 5% because they are the basic needs. But in case of travel and for any other purpose, gifting, buying property, for shares, for the parking funds abroad, you need to pay 20% TCS. So supposedly you are sending $100,000 to US to your family as a gift, you have to pay $20,000 as TCS to the bank, which would be reflected in your form 26AS, and you would get the benefit at the time of filing your return. Now we should understand why this amendment has been made. There's always a reason for any amendment which the government is making. If you see the foreign exchange reserves of a country, since December 2021, they have come down. So in December 2021, we had around 634 billion US dollar reserve, which coming to December 2022 has remained $562 billion. And one of the reasons which was understood by the government is high net worth individuals, ultra HNIs are moving out of the country, and they are taking benefit of the LRS scheme to shift their funds from the country outside. Now, one way to cater was to reduce the limit of $2.5 lakh. Another way is to increase the TCS rate. Government proposed to increase the rate of TCS, and they did not tinker with the limit of LRS of $2.5 lakh. Now, with increasing the TCS rate, they have actually achieved many more objectives. Earlier the limit of 7 lakh rupees was there. Now there is no limit of 7 lakh rupees when it comes to 20% TCS. So this will promote inbound tourism. rather than outbound tourism. So people would now prefer going to tourist places within the country rather than taking foreign tourism. So apart from shifting of funds, this new TCS rate would also promote tourism in our country. So this TCS rate would be applicable from July 1, 2023. So if anyone wish to send money abroad and want to take benefit of their LRS scheme, they can do it one before March 31st, because this would be a financial year. So $2.5 lakh before this 31st of March. And then you can also send before July 1, so that you can save on the 20% TCS. Online gaming, online gambling is now something new. Every time we open television and we want to see a match, we have different ads coming in, and different applications are there which are giving some cricket games, make money, invest money, make your team, dream team, etc. So just to make sure that any winnings from all these online games doesn't go tax free, two amendments are being proposed by this budget. One is with regard to taxability of winnings from online games, and one is regard to withholding tax on winnings from online games. So one is, it is very simple, very plain. Whatever you are earning through these online games, which are used through your telecommunication device or computer resource or internet, etc., would be taxable at a flat rate of 30%. So section 115 BBJ is proposed to be introduced, which would tax this. Any net winning is not defined though, but we are expecting that a circular would come around this to clarify things. Any net winning would be taxable at the rate of 30%. Simultaneously, a provision for TDS has been introduced, that while withdrawing these funds by the user from this application, a TDS of 30% has to be deducted by that online gaming company. This would be at the time of withdrawal of funds from the app or from that device or from that software which they are providing. If, for example, the winning is partly in cash and partly in kind, and the cash portion is not enough to meet the TDS amount, then the payer has to make arrangements to ensure that the tax has been deducted and paid to the government. So TDS provisions are applicable from July 1, 2023, and taxability arises from 1st April 2024, that is assessment year 24-25, that is financial year 23-24. There are few amendments around business trust. We have certain real estate investment trust and other investment trusts which are operating through SEBI, and any income generated by these REITs and InvITs is passed through. By pass through, what we mean that these are not taxable at the end of REITs and InvITs, but these are taxable in the hands of the unit holders of REITs and InvITs. So, for example, a real estate investment trust has invested funds in a real estate project, and they're earning income out of it in the form of rent, dividends, or interest, then that would not be taxable in the hands of REIT, but it would be taxable in the hands of the unit holder who holds bonds or say units in that real estate investment trust. So supposedly I have invested 100,000 rupees in a real estate investment trust. So for that 100,000, I would get a return, and that return might be in the form of dividend, rent, or interest. And hence I have to pay the tax as it is. It would be considered as my rent. It would be considered as my dividend or my interest. Now, interestingly, from last 2 years, when we are also catering tax returns of our clients and who have invested into REITs and InvITs, there are some miscellaneous withdrawals which are coming from REITs and InvITs, which do not have any head. So if you see the income chart which REITs or InvITs provide you, they provide you that in detail under which head they are giving you the funds. So whether it is interest, dividend, or rent. But from last 2 years, there are certain miscellaneous distributions which are coming, which do not have any head. And this was a bit challenging for us also to consider whether to consider that as taxable or not. So to ensure that and to plug that loophole, the government said that any miscellaneous distributions which are now coming apart from any income head would be considered as a return of the investment which you have made. So supposedly you have received 10,000 rupees from a REIT, out of which 1,000 rupees is dividend, 1,000 rupees is rent, 1,000 is interest, and 7,000 is miscellaneous receipt. And you have invested only 10,000 rupees in that, or say supposedly you have only invested 5,000 rupees in that real estate investment trust. So 3,000 is your straightforward income because it is dividend, rent, and interest. The balance 7,000 is your miscellaneous receipt which you have received. Your investment was 5,000 only. So the government would consider it as return of your investment. You would deduct your cost of acquisition. So 7,000 minus 5,000, rupees 2,000 would be your income for that year. And supposedly next year you again receive another miscellaneous receipt. Since your cost of acquisition has already been adjusted, the whole amount of miscellaneous receipt which you would receive would be considered as your income for that year. This would be applicable from assessment year 24-25. Earlier, a non-resident who has invested into REIT or InvIT was not allowed or was not given an option to apply for a lower withholding tax certificate to the department. So to avoid that and to give that benefit to non-residents, Section 197 is proposed to be amended, wherein non-resident would have a choice to approach the tax officer and seek a lower withholding certificate for distributions which are to be received from REITs or InvITs. Around dispute resolution, the government has been working on this litigation and dispute resolution all this while they have come into play. And since their first budget till now, from the day Mr. Arun Jaitley took the chair and now Ms. Sitharaman is taking the control of Finance Ministry, many provisions or many amnesty schemes were introduced. So first was IDS, Income Disclosure Scheme, then Foreign Asset Disclosure Scheme, then Vivad Se Vishwas Scheme, then Pradhan Mantri Yojana Scheme. So there were many amnesty schemes which were introduced, and the basic aim or criteria around all those schemes was to reduce litigation, reduce tax litigation. If you just see the number, we have around 4.5 lakh matters, which is a huge number, which is pending before CIT appeal. And if you see the practical aspect of it, since COVID lockdown, around COVID lockdown, CIT appeal has become faceless. Ask anyone who is in this line and who is taking direct tax litigation. We haven't received any major orders from any CIT appeal. So since 2020, now 2023, CIT appeals are not practically doing any work. They are only issuing orders in petty small matters just to fulfill their numbers. The matters are pending since 2015, 2014, 2013, but no major orders are coming in. We have filed various applications for early hearing. We have requested, but there is nothing happening around it. So to reduce that burden on CIT appeals, this finance bill proposes a new authority totally. So we would now have a simultaneous authority which would be similar to that of CIT appeal, and which would be known as Joint Commissioner or Additional Commissioner Appeals. So this authority would, though they are junior to Commissioner Income Tax Appeals, but they would have powers similar to that of CIT appeal. Now, which matter would go to CIT appeal and which matter would go to GSC appeals, Joint Commissioner appeals? The finance bill proposes only small and petty matters would go to Joint Commissioner appeals, and only big and major matters would go to Commissioner Income Tax appeals. So what are those matters which would go to Joint Commissioner appeals? First, any appeal around intimation received under section 143(1). Now, as we all know, 143(1) intimation is technologically driven, automated, and hence you receive adjustments because of difference in tax audits and information with the tax department and the information filed in the tax returns. So if there is any adjustment which is made under 143(1) intimation, you can appeal before Joint Commissioner appeals. Any order of assessment, reassessment, or recomputation under section 147, which is the reassessment regime. Any order under section 201, which is any order if you receive for failure to deduct or pay TDS, simultaneously any order for failure to deduct or pay TCS, any order imposing penalty under chapter 21, which is 270A, 271(1)B, your 271D, your penalties for non-appearance, your penalty for cash, 216SS, 216ST, etc. And any order of rectification relating to the aforesaid. Although the finance minister in the speech said that only small petty matters would go to JC appeals, but if you see second row, an order of assessment, reassessment, or recomputation under 147 and an order imposing penalty can be huge, and they may be difficult for Joint Commissioner appeals to consider those matters, because the quantum involved in those kind of matters would be very huge. Hence, the budget also proposes inter-transfer of appeals between CIT and Joint Commissioner appeals. So if any such kind of matters which are now currently pending before CIT appeal may, at the instructions or notification issued by CBDT, may be transferred from CIT appeal to Joint Commissioner appeals. Similarly, matter filed before Joint Commissioner appeal can also be transferred with CIT appeal if there is any reasonable basis or reason for that. CBDT is empowered to issue notification and also make Joint Commissioner appeal faceless the way CIT appeal is. So JC appeals will most probably be also faceless. While transferring the matter between both the authorities, opportunity of hearing would be provided to the assessee and the taxpayer. Amendments would be made to section 246 and a new authority would be introduced in section 116 of the Income Tax Act. This would be applicable from assessment year 23-24. So for financial year ending March 23, this would become applicable. The only thing is now when Joint Commissioner appeals would be constituted and would come into play. There are few amendments, or I would say there are some major amendments which are around charitable trust. So if there is any firework which is there in the budget is around the provisions around charitable trust, and I have received many calls from my clients who have charitable trust within their organization, and they want to understand the implications of the amendments which have been proposed. So there are a few other amendments which we are only taking few of them. So one of the amendments which is proposed is with regard to the exit tax. So recently in 2021, the whole structure of registration and provisional registration of all the trusts was changed. And all the trust, charitable trust or religious trust were asked to re-register themselves through the income tax portal, and they would receive automated sort of registration, provisional registration, which would be applicable for 3 years. Now amendment has been proposed under the provisions of charitable trust that if a trust fails to get itself registered or approved before its approval or registration expires. So supposedly, if before expiring the 3-year provisional registration, the trust or a religious trust fail to get themselves registered again, then they would be considered or deemed as if they are not a charitable trust, and they would be considered as if they have exited this whole regime, and they would be liable to pay tax on their accumulated income at the maximum marginal rate within 14 days of the last date of the application. So, how this accumulated income would be calculated? It would be your fair market value of assets less fair market value of your liabilities. The balance would be considered as your total income for exit tax purposes. That would be taxable at the rate of 30%, maximum marginal rate. So this is one thing which is very challenging and very worrisome. For example, or just for instance, if a person for genuine reason or for a reasonable cause just misses the deadline by a day or so, then boom, you would be slapped with a huge tax notice, and all your net worth practically of the trust would be chargeable to tax at the maximum marginal tax rate. So some benefit or some leeway should be provided around this. If someone misses the deadline by few days, either through condonation of delay, he can apply to principal CIT, or something should be provided. Some benefit or some leeway should be there. Around that, another amendment which is proposed is inter-charitable trust transfers. So what is used to happen that one charitable trust is giving donation or contribution to another charitable trust and claiming 100% benefit of it. So the government said that this is now being used as a route for a chain of trust to park their funds in different trusts and avoid 15% accumulation under 12AB, 12A, 1023C. And hence, now from assessment year 24-25 onwards, if a charitable or a religious trust gives any donation to another eligible trust or institution, then you would only be eligible for exemption of 85% of that amount paid or credited. So supposedly I, XYZ trust, charitable trust, pay 100 rupees donation to ABC charitable trust. Now earlier I used to get 100% exemption benefit. Now I would only get 85% of that as a benefit. Another amendment which is proposed is that exemption to trust or institution would be available only if the return of income is filed within the prescribed timeline. So for example, if you have not filed your return within the prescribed timeline and you file an updated return, then you would not get the benefit of exemption under 12A, 2023C. You would only get the benefit if the original return under section 139 is filed within the due date. So there are a few amendments around the procedural side, around assessment and reassessment proceedings. The timelines have been again changed. Government is, trying to get the best out of the taxpayers and the tax officers, and have been tinkering with the timelines now and then. So it initially started from 21 months, then came to 18 months, then 12 months, and then last year it was moved to 9 months. So for any regular assessment, the time period for concluding the assessment was 9 months from the end of the relevant assessment year in which the return was filed. Now, since last year, a lot of taxpayers followed a lot of issues while catering their assessments, because the time period was very short, 9 months, and they could not arrange the documents, and simultaneously the tax officers, inspectors also found it difficult to conclude assessments in huge matters within that time frame. Hence again, it is now proposed to enhance that time period from 9 months to 12 months. In case of updated returns, this period would be applicable from end of the year in which such return is filed. And for regular returns, it would be from the end of the relevant assessment year. So now we have already received notices for assessment year 21-22, or we would receive it by June, I guess. So these amendments would be applicable for assessment year 22-23 matters onwards. So for matters for assessment year 22-23, the timeline would be 12 months and not 9 months. It would not, 12 months would not be for matters pertaining to assessment year 21-22. Around the search, if any matter assessment or reassessment under 143.2 or 147 is pending as on the date of search, then that respective proceedings would be extended by 12 months. Around transfer pricing, the timeline to furnish transfer pricing study report or TP documentation under Rule 10D, Section 92D has been enhanced or has been reduced from 30 days to 10 days. So earlier the law said that you have to file the TP documentation before the transfer pricing officer within 30 days of receipt of the notice. Now the law says only 10 days. Domestic transfer pricing has also now been introduced for cooperative societies, cooperative manufacturing societies who have given the benefit of concessional tax regime of 15%. So this finance bill also introduced new provisions for cooperative societies, and a benefit of concessional rate of 15% tax rate is provided to those cooperative manufacturing societies who are engaged into manufacturing activities and who fulfill certain criteria and do not take necessary deductions. So for those cooperative societies, domestic transfer pricing would be applicable. Around thin capitalization rules, Section 94B is proposed to be amended, and NBFCs are now taken out of it. So thin capitalization rule would not be applicable on non-banking financial corporations. Business reorganization, mergers, demergers. So if you notice there, or if you have noticed, there are many case laws or many litigation around assessments or returns around mergers, demergers, because when merger happens or demerger happens, one of the entities loses its identity and assessment proceedings are initiated against those entities, and then the taxpayer take a plea that no notice could be issued on a dead entity, and this is now a settled law by Supreme Court in the case of Maruti Suzuki, that any notice issued to a dead entity is a nullity, is a null and void. So to cater that and to avoid this whole litigation and to give benefit to the taxpayers as well as to the tax authorities, last year, Finance Act 2022, scheme of business reorganization was introduced under income tax law, wherein a modified return has to be filed. So as per the amendment which was introduced last year, Finance Act 2022, any successor company has to file a modified return within a period of 6 months from the date they receive an order from NCLT. So supposedly I file an application for a merger or demerger before NCLT. My effective date would be very much prior to the date when the order would come. So supposedly today I filed an application for merger before NCLT, and my effective date is considered to be, say, July 2022. And now NCLT takes another 2 years to give an order. So hence I would have to file a modified return for this period, the effective date, which I've considered in that my application for merger demerger within a period of 6 months from the date of order. Although this was taken care by Finance Act 2022, but there was no procedure of assessment which was there on the modified return. So by this budget or by this finance bill, the government proposes provisions for undertaking modified assessment of those modified returns. So if assessment has already been completed before the modified return is filed, the tax authority would amend such order as per the modified return. And if assessment proceedings are pending, then tax authorities would pass order after considering the modified return. So we come to the last slide of our today's key direct tax proposals, and these are miscellaneous, few important miscellaneous amendments which are proposed out of the 122 amendments which are being proposed. So last year, TDS provisions were introduced through Finance Act 2022 on benefits and perquisites and virtual digital assets. And this year, provisions of TDS have been introduced for online gaming. Although TDS provisions were introduced last year for virtual digital assets and benefits and perquisites, but maybe it was a mistake that amendments were not introduced in penal and prosecution provisions, including default under these sections. So now this has been rectified through this finance bill. And if there is any default in deducting or paying taxes under 194R for perquisites or benefits, or under virtual digital assets under 194S, or for online gaming, then you would be chargeable, or you should be ready for penal consequences and prosecution under 276C(b). Again, another amendment which is interesting is assistance during search and seizure. Recently, or in the last 1 year, I've been doing a lot of search and seizure matters, and I've been part of few of them. And what I've noticed that tax department is now really digitized, and they have a lot of new age softwares, applications, and they're taking benefits of third-party consultants as well to cater that, and to cater that changing digital environment and the kind of tax evasion which is happening, considering you have transactions of virtual digital assets, Bitcoin coming in, blockchain, funds transfer through blockchains, etc. And to cater all these, the tax department needs people, expert people, specialists, and hence amendments have been introduced under section 132 and chapter of search and seizure, wherein the search officer is authorized to seek requisition of service of third party, and he is also authorized to get the valuation of the properties found during the course of search through third parties. So this is something which is for the benefit of the tax department. In last few of the searches which I am being part of, there are huge transactions around Bitcoins which were found. There are huge wallets. There are many transactions pertaining to marketing activities which are done through online, and the structures are so complex that it is very difficult even for professionals like us or the department to understand, and we need help of forensics to our department needs help of forensics to decode those kind of transactions which are being done through blockchains, etc. Simultaneously, like there is amendment which is introduced in search and seizure, special audit has also been enlarged. Generally, special audit was done or got it done by the department from expert chartered accountants, which are empaneled by them whenever there is any complexity in the accounts or books of accounts of the person or the taxpayer. If there is any complexity in the nature of the business or transaction or accounts, the tax authorities may direct the taxpayers to get their account special audited through a paneled chartered accountant. Now, to ensure that the inventory is valued perfectly, because there has been a lot of litigation wherein inventory is being valued by the tax officers themselves during the course of search, and taxpayers have raised questions and queries around their expertise in valuing and in their expertise in counting the stock during the course of search. to cater that, this amendment is now being proposed, wherein the tax officers are authorized to appoint cost accountants to value the inventory. Though opportunity of hearing would anyways be provided to the taxpayers, except in case of ex parte assessments. This would be applicable from assessment date 23-24. So as we speak, the moment the finance bill gets assent and becomes an act, this would be applicable. Thank you so much for a patient listening, and this is all from my side. If you have any questions, most welcome. We can take it now, or we can take at the end of the session also. Over to you, Nidhi.
Yeah, thank you very much, Pranshu. So should we take up questions if somebody have any questions now on direct taxes?
Nidhi, we can take the questions in the end. So
So I'm not sure with whether Pranshu will be there or not.
Okay.
You'll be there, Pranshu?
Yes, I will be there.
Okay, then. So I would also request participants, if they have any questions, they can start posting also if they want on the chat box. Okay. So Shreya, we need to change this. Okay, so we'll move to indirect taxes proposals now. So at this time, the budget talked about indirect taxes first, and the idea for the proposals this time is mainly to again promote exports and boost domestic manufacturing and enhance the domestic value additions, and also see that there is encouragement to green energy and mobility. So based on this thrust, there has been some changes in the customs, and they have rationalized customs duty rate, and also they have given certain changes in the GST eventually arising out of the budget. So I am now handing over to Sarthak and then to Sourabh for taking up the changes by this indirect taxes changes in GST, etc. Yes, Sarthak.
Right. So I'll just start my presentation. So is my presentation visible?
Yes, perfectly. Okay.
Great. So a very good evening to all the participants and the esteemed speakers. Thank you, Pranshu and Nidhi, for the useful insights on today's topic, and thank you, Shreya, for the kind introduction earlier. I would also like to thank BRICS CCI for organizing today's digital webinar on the union budget developments. It's always been a pleasure to be speaking and deliberating views on this illustrious platform, which is provided by BRICS. So to start with, indeed, this budget proposes a series of measures to unleash the potential of the Indian economy. A lot of steps have been taken to cut down the compliances and promote ease of doing business to support small and medium enterprises across the nation. So from a GST perspective, there have been few proposed amendments which largely aims to reduce tax burden and improve tax administration. Though there have been limited number of GST amendments that are proposed in the Finance Bill 2023, reason being the multiple and frequent GST Council meetings, notifications, and circulars, which take the load of GST amendments throughout the year and thus not depending upon the annual budget anymore. In my view, one of the key expectations from this budget was the introduction of an amnesty scheme in order to settle the disputes which have arisen under the GST law since it was introduced on July 1st, 2017. Formation of GST Appellate Tribunal was another aspect which I thought would be focused on this budget as far as the GST amendments are concerned. However, to my surprise, no such proposals have been made in the union budget. So nevertheless, it cannot be denied that the government is trying its best to ease compliance burden on the taxpayers and is simultaneously ensuring that there is less ambiguity in the GST law. So if you read the economic survey that was released and tabled before in the parliament before the budget, a lot of discussions have been made as far as GST is concerned. Some of the key highlights that catches attention is that GST has proved to be a vital revenue source for the central and state governments, with the gross GST collections increasing at 24.8% on an annual basis during the period of April to December 2022. Importantly, the government collected rupees 1.56 lakh crore as GST last month in January 2023. This figure is the second highest figure, only to the record figure of 1.68 lakh crore GST, which was collected earlier in April 2022. Further, the tax base and registrations have increased over the past years, with the number of GST taxpayers increasing from nearly 70 lakhs in 2017 to more than 1.4 crore in 2022. Also, the GST return filing mechanism has resulted in better income reporting, simultaneously leading to higher collection of income tax and direct tax collections. So these key highlights provided under the economic survey largely gives an impression that GST law is flourishing, developing, is on the right track, compliances are taking place, systems are functioning smoothly, GST collections are improving, and more taxpayers are becoming part of it. So as you can see the screen, around 15 amendments have been proposed in the CGST Act, and 2 amendments have been proposed in the IGST Act. These proposals have been made on the basis of the recent recommendations which was made by the GST Council in its meetings. So these changes broadly relate to facilitation, simplification, and improving GST compliances. So the amendments proposed in the Finance Bill 2023, wide clause 128 to 144, will be notified from a date to be notified except clause number 142. So basically clause 128 to 144 except clause number 142 will come into effect from a date which shall be notified later on. And the amendment which is proposed in clause number 142 of the Finance Bill will come into effect retrospectively from July 1, 2017. So firstly, an amendment has been made in section 10 of the CGST Act, wide clause 128 of the Finance Bill. So just to give all of you a short background, under section 10 of the CGST Act, there is a simplified composition scheme which is prescribed for smaller taxpayers. Such scheme offers the benefit of a flat GST rate with a minimum documentation and ease of compliances under the GST law. So there are 2 classes of composition taxable persons. Firstly, the manufacturers and traders who are involved in supply of goods, and secondly, the supplier of services. So these 2 classes of composition taxable persons can obtain the composition scheme subject to certain conditions which have been prescribed under section 10 of the CGST Act. So in the current scenario, there is a common condition for availing composition scheme for both these classes of taxpayers, and the said condition is prescribed under section 10 subsection 2 clause D and section 10 subsection 2A clause C of the CGST Act. Such condition prescribes that a composition dealer should not be engaged in making any supply of goods or services through an e-commerce operator who is required to collect TCS under section 52 of the CGST Act. In other words, even if a single transaction through the e-commerce operator is carried out by a supplier of goods, then he would not be able to claim the benefit of the composition scheme provided under section 10 of the CGST Act. So now the proposed amendment under the Finance Bill seeks to remove such restriction and extend the composition scheme benefits to persons who are supplying goods through e-commerce operators who are required to collect TCS under Section 52. So in my view, this amendment is a welcome step. And once the said proposal is approved, the supplier of goods opting for composition scheme shall be allowed to make supply of goods through e-commerce operator and also participate in technology-driven marketplaces like Amazon, Flipkart, Instamart, or Snapdeal. So, however, the catch here is that the composition taxpayer would still not be able to make interstate supplies through e-commerce operators. So, any supplier of goods who wants to sell its products through e-commerce platform will only be limited to selling the goods within a particular state. He will have to make sure that he does not end up making interstate supplies through the e-commerce operator. And another point which is to be noted here is that this amendment is only beneficial for persons who are supplying goods, and it does not extend to persons supplying any services. So therefore, the condition under Section 10, subsection 2, clause D, and Section 10, subsection 2A, clause C, of not supplying services through e-commerce operator required to collect TCS would also continue post the amendment is notified. So this benefit is only extended for the persons who are making supply of goods within a particular state. So additionally, clause 128 of the finance bill proposes to insert a new subsection, which is subsection 1B, and such subsection is to be inserted in section 122 of the CGST Act. So such proposal has been made to provide penal provisions applicable to e-commerce operators in case there is contravention of provisions relating to supplies of goods or services made through them by unregistered persons or a composition taxpayer. So in case of any contravention of any provision relating to supply of goods or services made through an e-commerce operator by unregistered persons or composition taxpayers, then in such a scenario, the said e-commerce operator shall be liable to pay a penalty which would be at least 10,000 rupees under the CGST Act. So this amendment would definitely pose an additional burden on the e-commerce operator, because going forward, the e-commerce operator would need to ensure that supplies made through their portal by unregistered persons or composition taxpayers does not contravene any of the provisions of the GST legislation. So it can be said that by this amendment, the government wants to ensure that there is no tax leakage or there is no any non-compliance which takes place through any of the supplies which are undertaken through any of the e-commerce operators. So moving on to the next proposed amendment. So you all must be aware that Section 17 of the CGST Act deals with apportionment of credit and block credit. Section 17 also talks about reversal of input tax credit in case of taxable supplies as well as exempted supplies. So in this regard, as per subsection 2 of Section 17, it has been provided that where a registered person procures goods and or services for effecting supplies, taxable supplies, as well as exempted supplies, then in such a scenario, the amount of input tax credit shall be restricted to the amount which is attributable to the taxable supplies. So in other words, in case of common input services and capital goods are used for supplying taxable supplies as well as exempted supplies, then in such a situation, the input tax credit shall have to be reversed proportionately as attributable to the exempted supplies. So basically Section 17 subsection 2 के अंदर एक provision है which says that if a supplier is rendering both taxable supplies and exempted supplies, then ITC input tax credit shall have to be reversed proportionately to the extent it is attributable to the exempted supplies. So the manner for such reversal has been prescribed under Rule 42 and Rule 43 of the CGST rules. Further explanation to Section 17, subsection 3 provides that for the purpose of reversal of common input tax credit, the value of exempted supply shall not include the value of activities or transactions specified in Schedule 3, except those specified in paragraph 5 of the said schedule. So basically the transactions covered under Schedule 3, except for the transaction covered under paragraph 5, will not be taken into consideration for the purpose of reversal of common input tax credit under Rule 42 and 43 of the CGST rules. So now, while clause 130 of the finance bill, such explanation is proposed to be amended. Such proposal seeks to restrict availment of input tax credit in respect of certain transactions specified in para 8A of Schedule 3 of the CGST Act. So para 8A of Schedule 3 of the CGST Act provides that supply of warehouse goods to any person before clearance of for home consumption shall neither be treated as a supply of goods nor a supply of services. So therefore, in case any registered person who is involved in supply of goods through bonded warehouses, then value of such supply shall be deemed to be considered as an exempt supply, and accordingly input tax credit shall be proportionally reversed under Rule 42 and Rule 43, considering such supply as an exempt supply. So in my view, persons who are involved in effecting taxable supplies and supply of goods through bonded warehouses will have to undertake compliances of Rule 42 and Rule 43 once this amendment, when this proposal is notified. So another important amendment proposed in the union budget is the restriction of input tax credit incurred on CSR expenditure. So you all must be very well aware that there have been multiple litigation and rulings on the subject of availment of input tax credit incurred by corporates on CSR expenditure. So there have been divergent views on this issue of availment of credit on CSR expenditure, and the industries across the nation has been divided on whether the input tax credit related to CSR would be available or not. So now this ambiguity has been resolved by the government. The finance bill proposes to clearly restrict any input tax credit paid on goods or services that are used or intended to be used for activities related to obligations under the corporate social responsibility referred in Section 135 of the Companies Act. So this proposed amendment provides a much needed clarification on the treatment of input tax credit towards CSR expenditure. So in my view, this clarification will bring out uniformity in the approach to the which is to be adopted, and would also end up the unnecessary litigation that has occurred since the inception of GST. So going forward, once this amendment is notified, then the input tax credit of GST incurred towards CSR expenditure shall not be available in terms of the newly incorporated Section 17, subsection 5, subclause FA. So the government has made it very clear that no ITC shall be available in respect of CSR expenditure. So the next proposed amendment is with respect to GST registration. So it's a very interesting change because in the current scenario, there is an ambiguity between the applicability of Section 22, Section 23, and Section 24 of the CGST Act. So Section 22 of the CGST Act states that in case the turnover of a taxpayer exceeds the threshold limit of 20 lakhs or 40 lakhs as the case may be, then in such a scenario, GST registration will have to be obtained by such taxpayer. On the other hand, Section 23 states that a person engaged exclusively in the business of supplying goods and or services that are not liable to tax or wholly exempt from GST are not liable to take registration. Further, Section 24 of the CGST Act prescribes the scenarios where a person is required to take compulsory registration under GST. So one of the mandatory conditions prescribed under Section 24 is that a person required to obtain registration is required to take a registration in case he is liable to deposit GST under reverse charge mechanism. So any person who is involved in supply of goods and those goods are specifically exempted from GST, and further there is any inward transaction which is liable to GST, then as per the Section 24, the said person shall be liable to take registration under Section 24 of the CGST Act. So because of this ambiguity, persons who were wholly engaged in exempted supplies or non-taxable supplies and their inward transactions were covered to reverse charge mechanism did obtain GST registration earlier. So now clause 131 of the finance bill seeks to provide an overriding effect to Section 23 over Section 22 and Section 24 of the CGST Act. So it means that persons who were required to take compulsory GST registration as required under Section 24 of the CGST Act need not register themselves if they are not liable for registration or are exempted under Section 23 of the CGST Act. So in my humble opinion, this amendment is a welcome step which brings end to the conflict between the interplay of provisions of Section 22, Section 23 and Section 24. So once this amendment is made effective, if a supplier is covered under the scenarios of Section 23, then no GST registration is required to be obtained either under Section 22 or 24. So the government has put an end to the litigation that arose in the past years regarding the GST registration. So, this slide deals with putting timelines with respect to filing of certain GST returns, GSTR 1, GSTR 3B, GSTR 9, GSTR 9C, and GSTR 8. So, white clause 132, 133, 134, and 135, new subsections have been inserted under Section 37, Section 39, Section 44, and Section 52 of the CGST Act. So, all these new subsections states that a GST return can be filed maximum up to a period of 3 years from its due date, meaning thereby GSTR 1, GSTR 3B, GSTR 8, GSTR 9 or 9C would now be restricted for filing post expiry of 3 years from the due date of filing of the relevant return. So till date, there was no time limit for filing the GST returns, and any taxpayers could file belated returns of the past financial year after the payment of interest and late fees. But once this proposal is notified, then the taxpayers will not be able to file belated GST returns in case 3 years have passed from the due date. So in nutshell, the government is saying that a taxpayers has a time limit of 3 years to be tax compliant. So it is recommended that any taxpayer who has not filed GST returns for the past few years, let's say beginning 2021, then the same should be filed at the earliest after payment of interest and late fees before this provision is notified. Because once this provision is notified, then a taxpayer will not be able to file the returns of the past years where 3 years have already been lapsed. So another welcome change is in Section 132 of the CGST Act, which deals with the arrest provisions. So in the last GST Council meeting, it was decided that certain offenses under GST would be decriminalized. In this backdrop, a proposed amendment has been made via clause 139 of the Finance Bill 2023. So such proposal seeks to amend subsection 1 of section 132 of the CGST Act so as to decriminalize the offenses which are specified in clause G, clause J, and clause K of the said subsection. In other words, these three specific types of offenses have been decriminalized where there cannot be any arrest in case a person commits such offenses. One such offense is obstructing or preventing any officer to discharge his duties. Second is deliberate tampering or destroying of any material evidence. And third such offense is failure to supply any required information by the GST officer. So by this proposed amendment, these three offenses have been decriminalized, which was already proposed in the last GST Council meeting. So once this proposal is notified, then there will only be penal provisions applicable for these offenses, and no arrest can be made in case any person commits such offenses thereafter. So apart from this proposal, clause 3 of section 132(1) of the CGST Act has also been proposed to be amended. Such amendment has been proposed to increase the monetary limit from 1 crore to 2 crore in order to launch prosecution in case of offenses other than the offense of fake invoicing. So for the offense related to fake invoicing, the prosecution will continue to be 1 crore. So in case a person is charged with the case of fake invoicing and the quantum involved is more than 1 crore, then in such a scenario, prosecution can be launched against such person. However, for the balance offenses, the threshold limit has been revised to 2 crore for launching prosecution. So the last amendment that I would be discussing today is the retrospective amendment made in para 7, para 8A, para 8B, and explanation 2 of schedule 3. So just to give all of you a brief background, transactions mentioned under these para were inserted with effect from February 1, 2019 in order to keep them outside the ambit of GST. So transactions under these para includes supply of goods from a place outside the taxable territory to another place outside the territory, and it also involves high sea sales, supply of warehouse goods before their home clearance. So no GST is applicable on such transactions, the same being non-GST supply. However, recently, in some cases, the GST authorities have been demanding GST on such transactions for the period July 1, 2017 to January 21st, 2019. So to clarify this ambiguity, Schedule 3 of the CGST Act is being amended to give a retrospective applicability to para 7, para 8 and para 8B of the said schedule with effect from July 1, 2017. So accordingly, the activities and transactions mentioned in such paragraphs would neither be treated as a supply of goods nor a supply of services with effect from July 1, 2017. So therefore, no GST can be demanded for the period of July to January 19 by the GST department. After this clarification comes, this amendment is notified. Furthermore, it has also been clarified in explanation 2 that where the tax has already been paid in respect of such transactions and activities during the period from July 1 to January 31st, 2019, then in such a scenario, no refund of such tax shall be available. So the government has clearly taken a stand here that in case any tax has been paid by an assessee for this period, then no refund shall be granted to such person. So this also seems to be a welcome amendment and a big respite for taxpayers who are undergoing a litigation on this aspect. Thank you. It was a short presentation though, because there are very few amendments in the GST law. So now my colleague Sourabh would be discussing the key proposals under the IGST Act. Sourabh, over to you, please.
Thank you, Sarthak, and a very good afternoon to everyone. So we'll now take up the IGST related proposals. In fact, there are a couple of proposals under IGST Act, and one is specifically related to online information and database access or retrieval services, commonly known as OIDAR services. So while this proposal, they have significantly enhanced the scope of OIDAR services by covering each and every service, irrespective of the fact that there is any human intervention or not. So the term in the existing provision, which says essentially automated and involving minimum human intervention, and the same was subjected to litigation, including the issue as to what is the extent of minimal human intervention. So they have now proposed to exclude this particular term from the definition of OIDAR services, and issue pertaining to automation and the degree of human intervention is done away with. Also, in the same set of OIDAR services, there is a change in definition of non-resident supplier who will be liable to GST for all unregistered recipients located in India, irrespective of the fact that the recipient is using that service for in course or furtherance of business or not. So the enforcement of these provisions related to OIDAR service has been a challenge for the authorities, and it will be interesting to look as to how much impact it will make in terms of incremental revenue for the government by enhancing the scope of OIDAR services. Another proposal is that related to place of supply under Section 12. So subsection 8 of Section 12 has been proposed to be amended, which talks about the place of supply provision related to supply of services by way of transportation of goods, where the location of supplier and the location of recipient is in India. So as per the existing proviso, where the destination of goods is outside India, then the place of supply of such transportation services falls outside India. With this proposed amendment, they are omitting this proviso to specify that irrespective of the fact about the destination of goods, the place of supply shall fall in India, since the supplier and recipient both are located in India. And this omission is in line with the circular issued on December 27th, which stated that ITC shall be admissible to the recipient even if POS is falling outside India or outside the state where such recipient is located. So these are the couple of proposals which are there in IGST Act. I'll now request Shankey to take up the customs related proposals. Shankey.
Thank you, Sourabh. Thank you for the nice summary of IGST related changes. Now I will be taking everyone through the customs and international trade related changes in the budget. So the finance minister in the budget has continued the momentum in the earlier budgets, wherein the main thrust of the government is that make in India and everything should be manufactured in India. So most of the changes in the customs law relate to facilitating Make in India, and there are a couple of administrative changes that they have done. So without further ado, let me just first take everyone through the legislative changes which are there in the Customs Act. So first change in the Customs Act, so some of you would be aware that in the year 2021, by the Finance Act 2021, the government had basically issued one provision wherein if any notification, conditional notification of customs, if it is issued, then it will automatically lapse within a period of after a lapse of period of 2 years, unless the same is extended specifically by the government. Now, this provision created one ambiguity whereby most of the customs notification which are perpetual in nature were also getting lapsed, and there was a constant source of anxiety in the industry as such, whether as to these notifications will continue or not. So the government in this budget have sort of rationalized this provision wherein it excludes all those notifications which are in relation to FTAs, FTP, and temporary imports, etc. So in effect, these notifications which are in relation to any bilateral, multilateral agreements, or some of the notifications which relate to re-imports, temporary imports, etc., will not automatically lapse after the expiry of 2 years. Now, this will provide a much needed clarity in the business, which will not have to stare at each year's budget to see if these notifications are continuing or not. So this is one rationalization measure which the government has adopted. Now, there is one innocuous looking change in the project import regulation, but this has wide ramifications for all the manufacturers which are engaged in solar power projects. So some of you would be aware that ordinarily the customs duty, basic customs duty on solar cells and solar modules is around 30 to 40%. But since most of the solar modules were used in the big, large solar power projects, most of these solar modules were imported under the project import regulations, which afforded the customs duty to 10%. Now the government, which is basically a mirror amendment, and government had actually issued one notification in the last year, October. The government has now made it absolutely clear that by excluding solar power plants from the project import regulation, that all these solar modules, solar cells, etc., cannot be imported under the garb of solar power projects. So this will really hit hard all the importers of the solar plants, etc., who were taking the concession rate of duty on these products. So this is the change. Another change which may concern a lot of people is the change in the settlement commission's procedure. So currently, there was no time limit as to by when a settlement application could be entertained by the settlement commission. So the government is in this budget has proposed that any application which is filed before the settlement commission has to be mandatorily disposed within the period of 9 months. Now, what it does is, after the 9, if the application is not disposed of within a period of 9 months, then it will be deemed that no such application has been filed, and adjudication authority will be free to decide such, decide on such offences. Now, where the government has missed out is that they have not clarified that this 9 months should not be lapsed. Sometimes there is no mistake on the part of the applicant. There is no adjournment request, and still the settlement application is not decided. Even in those cases, what may happen is that the person may be left without a remedy, and they may be consigned back to the adjudicating authority. And this will, while this change is a welcome change, but the legislature should have adopted some kind of qualification in the provision whereby the settlement application should not be rendered nugatory in case there is no fault from on the side of the applicant. So this is one important change to any person who is before the settlement commission already, and this provision will apply to all the pending application, but 9 months will be counted from the date on which this provision comes into force. Now, the next change is also an interesting one. This is in the Customs Tariff Act in relation to anti-dumping duty and countervailing duty. So some of you who may be interacting or maybe well versed with the procedure of anti-dumping duty, imposition of anti-dumping duty. So for others who are not that well versed, let me just summarize it in very detail. So Director General of Trade Remedies conducts a detailed investigation on whether an anti-dumping duty or such kind of measure should be imposed on a industry or not, on any imports or not. After the investigation, DGTR recommends the imposition of ADD or countervailing duty on any products. Now, Ministry of Finance may accept such recommendation, or may issue, or may delay issuing such notification, or they may reject such proposal. Now, the domestic industry was left without any remedy in case Ministry of Finance decides not to impose such duties. In the past, there have been several issues wherein the domestic industry has challenged non-action by the Ministry of Finance or non-imposition of anti-dumping duty before the CSTAT, and CSTAT in such cases have held that the Ministry of Finance decision to not implement the recommendation of DGTR is actually an appealable order. This became a bone of contention, and there have been many such cases, and presently the controversy is pending both before Delhi High Court and Supreme Court. Now, what they've done is the government has now proposed to clarify the provision, which simply has the effect that such decisions will not be appealable to the CSTAT, and therefore, effectively, in case Ministry of Finance decides not to impose any anti-dumping duty or decides not issue an office memorandum whereby they refuse to take any action, then there is effectively no remedy under the Act. But what can be done is probably a writ petition can be preferred by the domestic industry in such cases. So this is one change. Now I have covered all the legislative changes. Let me just very quickly run you through the important tariff changes in the Customs Act. So there are a few notifications which have been extended by 1 year. As we've already discussed, all these notifications would ordinarily lapse on 31st March 2023, but these have been extended by 1 more year. So the notifications on the inputs for manufacturing of LED lights, any lithium-ion batteries or battery packs for hybrid or electric vehicles, or any parts or raw material for manufacturing of aircraft has been extended by 1 year. Now, this extension of 1 year effectively means that next year there would be a lot of the industry may expect that these may be taken away because of the fact that these have been extended only by 1 year. Sourabh, next slide. There have been other notifications which have been extended for 2 years. So the most primary one is the parts of wind operated electric generators. So all the windmills parts have been extended by 2 years. Any parts used by dredging machines for the manufacture of ships and vessels. There are certain specified drugs, medicines, etc., bulk drugs used for manufacturing of drugs. These have been extended by a couple of years. There are also certain notifications which they have decided that it will lapse this year only, which is important to note, is machinery or raw material for the fertilizer plants. There are a few goods which are used in pharmaceutical and biotechnology sector. There are some machineries which are used in food processing sector. All these notifications will effectively lapse. So any of the people who are engaged in such sectors should be advised to view these notifications very, very carefully if some of these exemption notifications have actually lapsed. There are also a few changes in gems and jewelry sector, but the most notable change is the import of the articles of precious metals. So any jewelry of any precious metals earlier attracted an effective duty rate of 22%. So 20% was the BCD and 10% was social welfare surcharge. So effectively it was 22%. Now the basic customs duty has been increased to 25%, and the social welfare surcharge has been taken away. So effectively from 22%, the effective duty has become 25%. Similarly, there have been increase in the customs duty on silver and silver door. So this will effectively increase the price of jewelries which have been imported in India. There have been other changes in the customs tariff in gold bars, etc. But eventually, effective duty rate has remained the same in those sectors. So in the table which you can see on the screen, you will realize that while there have been substantial changes, but effective customs duty on these gold, etc., have remained the same. Now, the last change, which is actually very crucial for automobile sector is, and this is one of the key changes which will propel the Make in India ambitions of the government, is that the CKD kit or the SKD or the fully built units, the customs duty on those things have been increased. So any automobiles which are coming as semi-knockdown conditions, that earlier used to attract 30% tax, now it will attract 35% tax. And motor vehicles which were completely built units, whether it is electrical or non-electrical, earlier used to attract 60% duty. Now it will attract 70% duty. So interestingly, there was a lot of demand from from the industry sector, including Tesla, that this customs duty should be brought down from 60% to their initial demand was 30%. But on the contrary, the government has decided to raise it to 70%. So the government has given a very clear signal that they don't want a fully built unit to be imported in India. If anyone wants to do business in India, they have to start manufacturing or assembling in India. So these were the key changes, and I am open and for any queries in relation to these changes. Thank you, and I will now give it back to Nidhi and the team.
Yeah, thank you, Shankey, Sarthak, and Sourabh. So we have started getting questions. So I think even if somebody wants to ask questions on the chat box or by just speaking directly, then it will be good.
Yes, ma'am. We have a question from, I think, Srinath, which you had answered. The next question is from Naman. He asks, what will be done to keep inflation under control in the next fiscal year, I think.
So what we will do is that this question I'll respond, but at the same time, we have indirect tax or direct tax queries which are coming up. So one query I have just resolved, but there is an indirect tax query, I'll just read that.
The next question, ma'am, as India.
So from Yashika.
So there is one query, sorry Nidhi.
Yeah.
So there is one query which says, so Yashika has asked, can offences under CGST, SGST Act can be compounded? So Yashika, I mean, let me just attempt this. So Yashika, there is a provision under GST Act, section 138, if I'm not wrong, which allows any person to compound the offences. Earlier, the minimum amount for compounding was 100% of tax, but now they have, I think, reduced it to 50%. So you have to pay a compounding fee, and there is a specific provision under GST which allows compounding of offences.
Yeah, right. In fact, I'll add on to it. So Section 138 of the CGST Act deals with the compounding provisions. So basically, these provisions are also amended by the finance bill. So the offences which I discussed, which have been decriminalized, have been allowed to be compounded now, basically. However, there is no compounding in case of issue of invoice without actual supply of goods. So basically, in case of fake invoicing, I would say there is no compounding allowed under Section 138 of the CGST Act. And yes, as you mentioned, the amount and the rates have been rationalized by reducing the minimum and the maximum amount of the compounding rate. under section 138. Right.
So there is a question from Ashwin Kalra. As India is moving towards developing its manufacturing sector, but it's quite evident that we all are dependent on foreign machinery. So what's your take on this increase in customs duty of machinery with such promising desire?
Let me attend that.
Yeah, please. Yes.
Ashwin. Ashwin, what government is trying to do is, for last few years, the government was initially giving exemptions to all these machineries which are required to manufacture the goods. But now the government in the last 1 year, at least because this is evident from the last budget also, that the government wants even the capital goods to be manufactured in India. So the government is slowly now changing its stance, whereby, because earlier there was no manufacturing capacity in India. So government allowed a concessional rate of duty for capital goods. Now the government is changing its stand, and now they are saying that even the capital goods should be manufactured in India, and only the parts for such machinery are allowed to be imported at concession rate.
And just to add what Shankey said, so as we have seen that in certain areas, certain sectors, we have Make in India policy now. So what it talks about basically that there has to be indigenization in India. For that, it has to be minimum 50%. So for that, you have to have manufacturing in India, which is possible not just by import, by reducing, but also by acquiring or acquisition of foreign technology into India. So once the technology is in India, then the manufacturing itself with some imported components and parts and support from overseas can happen in India. So idea ultimately is to reduce the dependence from 70% on imports to about 50% or less than 50%. So that has been an attempt. So, so there will be somewhere there has to be start for reducing or increasing the customs duty rate in case of certain imports, but they have also reduced customs duty rate in certain important and which is too desirable or very important for India to manufacture, and even the platforms in India. So, so that's why there has been ups and downs and changes in the customs duty rate. And if you look at project import scheme, so there was a project import scheme where they have given the 5%, and they are now eventually it is going to get away. So that 5% benefit which they were giving over the period of, I think, around 30 years, so that has not given much support in case of increasing manufacturing in India. So somewhere the government's thrust has been now into reduce imports dependence and starts working in India. So that's why they are fading away, or they are taking away some of the benefits over the next or from last year till maybe next 2 to 3 years.
Okay, ma'am, I think we have another question in the chat box. Kritanya asks, in case the tax payable on finalization is less than the tax actually paid at the time of provisional assessment, how can the taxable person claim refund?
Is this an income tax query or a GST query? I think seems to be income tax one.
Sarthak, I think it's indirect tax because there is no provision of provisional assessment under income tax.
Okay. The query is not clear actually. The tax payable on finalization is less than the tax actually paid at time of provisional assessment. So are they trying to say that once they file the return, they are paying taxes on a provisional basis?
So I think, Pranshu, is this not something which they issue the notice before issuing ultimately the order, that it's a provisional assessment and you have a look if it is okay? So that's a kind, I think it's again 143(1)(a) before issuing the final order.
Yes, so that's an intimation. That's not also a provisional assessment.
But Kritanya? So Kritanya, is this related to income tax you want to mention, or?
Hi, yeah, Nidhi, it's related to income tax.
Can you please clarify around what exactly are you asking?
So the salary based people who receive their income, it's related to that. If you could just put some color around that.
Okay, so basically for salaried employees, if they're employed, the employer would deduct TDS on their salary and would remit the balance funds, the balance salary to the bank account, and the TDS would be deposited to the bank, to the government. And when you will file your tax return, then you would compute your tax liability. So if your tax liability is greater than the TDS which is already deducted, because you have other sources of income, then you have to pay extra tax. But if your tax liability is less than what TDS has already been deducted, then you can claim refund in your tax return, and that refund would be processed through an intimation order under section 143(1), and you may receive that refund within a period of so the government says that they have reduced the timeline from up to 16 days, but the law says 6 months. So you can receive your refund within a period of 16 days to 6 months.
Yeah. But this time, Pranshu, this time I think
Yes, ma'am.
not just the individuals, but in case of corporates also, the
Yes.
refunds have come so fast. It is so surprising. Then I just within 1 week or 3 days or 4 days, we have got the intimation, favorable intimation with refund mentioned in that.
Yes.
And then
But refund was never received.
no, I have in every case, in every individual, fortunately, in every individual, my own companies, everywhere we have received refund. In fact, it was better to claim refund than not claim refund at all.
So I think finance minister also spoke about
Yes,
this.
yes.
That
Yes.
Yeah, it
I
was.
think the
They
average
reduce it to
time
16
for
days.
93 to 16 days, the average time for processing the refund under income tax has been reduced.
No, you won't believe we filed one tax return, and the moment we filed, the next 5 minutes we received the intimation on our email.
Yeah. And I think what I just want to mention to everybody here that I have been in the practice for since 1995, and I've seen many changes in the taxes for all this. I think I will say that I've become veteran now. So, but at the same time, not just the changes, litigations have reduced, and then the departments have started hearing. Of course, GST is one subject which is separate, which is still evolving, but income tax has evolved and documentation has to be proper. Then filing has to be intact. If you could achieve all these things, then it is not that difficult. And there are many benefits which one can achieve. If you have seen in this budget, they have increased the limit from in 44 AD to 2 crores to 3 crores. Nobody has ever thought of using those sections, and even professionals are getting those benefits. So overall, if you look at it, they have been making attempt to reduce taxes, but yes, salary people are still, I think, more suffering in the taxes. There should be more benefits which should be given to the salaried people, because they do not have an opportunity to take deductions, higher deductions, for personal expenses. So, but over the period of years, there has definitely been changes in the taxes. And as Pranshu started, when he started his presentation, that it is the first budget in last 5 or 6 years with the present government that's the shortest budget. And I think it's a revenue, of course, tax revenue is going to get increased still with all those changes and the reductions of the rates.
Yeah, it is expected that the tax base would increase. Currently, around 5 crore individuals are filing their tax return, so they're aiming it to go up to 8.
So one of the reasons for increasing tax base is also GST, which was mentioned in the economic survey actually. So more and more people are taking GST registrations from 70 lakhs in 2017 to 1.4 crore in 2022. So automatically, since everything is electronic based and there is exchange of information between the CBDT and CBIC, then in such a scenario, definitely the tax base would increase. I mean, there will be a collateral benefit with the people taking GST registration and simultaneously filing income tax returns. So this is another aspect that I believe is a reason for increase in tax base, both for GST and income tax.
Any other questions?
No, ma'am, that was it. So I think with this, I would like to express my gratitude to all our esteemed delegates of this seminar for their presence and contribution to make it a great success. I extend my gratitude to Ms. Nidhi Goel, Mr. Pranshu Goel, Mr. Shankey Agrawal, Mr. Sourabh Besar, Mr. Sarthak Garg for taking time out from their very precious and busy schedule to give us something very invaluable and an understanding of the Union Budget 2023. Thank you for this insightful session that we have received from you today. We hope that our participants must have greatly benefited from it.
And thank you very much.
Thank you, Shreya.
Yeah.
Thank you.
Thank
you,
you so
everyone.
much, everybody.
Thank you.
Thank you.
Thank you.
Thank you. Thank you.
Good evening.